Welcome to the first video in our Four Corners of Retirement series. Today we're covering a broad but important topic, life insurance. Now, you've probably heard of life insurance and maybe you already have a policy, but here's the thing. Many people don't realize there are different types of life insurance, each designed for specific situations. So in this video, I'm going to introduce you to the three most common types of life insurance policies. The first type of life insurance is ideal for people who are in their 50s and beyond, and it's called whole life insurance. You might also hear it called final expense insurance. And as the name suggests, whole life insurance is designed to cover you for your entire life. Its key features are its permanent coverage. It stays in place as long as you pay your premiums. Your monthly premiums are fixed, so your costs don't go up over time, and the death benefit is also fixed, meaning your payout amount is not going to change. Typically, the payouts to your beneficiary are tax-free, and so the money goes to your beneficiary, whether that's family, friends, or a charity, tax-free to them. This type of account also accumulates cash value. Every month as you pay your premium, a portion of it goes to pay for the insurance and a portion of it goes into a kind of a savings account that you can draw from while you're still alive. Once your policy is approved, everything is locked in. There's no surprise rate hikes and no benefit reductions. Now, whole life policies can cover several different things. They have several different purposes. The most common is probably going to be funeral costs. This can include burial, cremation, and any other related expenses. The second is what's called final expenses. Things like outstanding debts, credit card balances, medical bills, or even a mortgage. Without insurance, those costs are often landing on a spouse or other family members, so that helps to take the burden off of them. And the third is income replacement. This one is very often overlooked. So here's a quick example. Imagine a couple where the husband gets $1,800 a month from Social Security and the wife gets $2,500 a month. So together, that's $4,300 per month. But when one spouse passes away, the smaller check stops. In this case, the $1,800. Now suddenly, the surviving spouse is living on $2,500 a month. A whole life policy, say with a $40,000 death benefit, can help reduce some of that lost income, giving the surviving spouse breathing room while adjusting to the new budget. Now the cost can vary depending on a few factors: your age, the death benefit amount you choose, and also your health history. Most of these policies don't require lab tests, but you'll answer some health questions and go through some underwriting. Based on the results, your application can be approved, denied, or adjusted for price and coverage amount. Let me give you a ballpark idea. Many people pay between $30 and $70 a month or higher. As you expect, the higher the premium, the higher the death benefit. And so just like with Medicare planning, we look at your age, your budget, and your family needs to see if a whole life policy makes sense for you. If this is something that sounds like it could help protect your loved ones, let's talk and see what options might be a good fit. And if you already have a policy, it's a good idea to review it just like we do with Medicare to make sure that you're up to date and that it's going to take care of things the way you expect it to. Also, one more point on this. When someone passes away, Social Security, the Social Security Administration, sends the surviving spouse $255. That's it. And so that's why this type of policy can really help to replace some of that lost income and extend a little bit of income. Now, the second type of life insurance we're covering is called term insurance, term life insurance. As the name suggests, term means that it's set for a specific period of time, usually between 10 and 30 years. Term life insurance usually comes with a much higher death benefit than whole life, and it's often geared toward younger people, especially those with young families, a mortgage, and all the expenses that come with raising kids. I'll give you a personal example. I have a wife and young children, and I own a couple of these policies myself. If something were to happen to me, my family wouldn't have to sell our home or worry about paying the bills. They get another, again, tax-free payout to cover those expenses. So how does it work? Term life is pretty straightforward. It doesn't build any cash value like whole life does, and if you outlive your term, the coverage simply ends. Now, some people say, so I paid all that money and I got nothing? Well, sort of. Think about it like your car insurance or homeowner's insurance. You pay for your protection and you hope you never need it. The big advantage? Term life is often very affordable. For example, a healthy person in their 30s might get $1 million in coverage for 30 years for less than $100 a month. This is insurance in its purest form. If something happens and your family gets a large payout, giving you peace of mind at a low cost. You may have heard the expression buy term and invest the difference. That's the idea. Keep your monthly premiums low, protect your family, and invest the extra money toward your retirement. If you have kids or grandkids with families of their own, especially if they own a home, term life is often the smartest way to make sure that they're financially protected if the worst happens. So, a common misunderstanding. A lot of people tell me, oh, I already have life insurance through my job. That's great, but is it enough, and will it last? Most employer-provided life insurance goes away when you change your job. And often the coverage is small, maybe $10,000 to $30,000. That's rarely enough to replace an income or cover major expenses. This is why it's important to review your family's needs and the coverage you already have, so you know for sure that your loved ones would be taken care of. The third type of life insurance we're covering is called universal life. More specifically, indexed universal life insurance, or IUL. This is one of my favorite types of life insurance because it's more than just a death benefit. It's what I like to call a hybrid policy. So, IUL is great for anyone age 55 and under. Yes, even children. Why? Because not only does it provide a traditional death benefit, it also builds cash value that can grow into its own retirement plan. The younger you start, the more time you have left to let that growth compound. How does it work? Each month, part of your premium covers the cost of life insurance, and the rest goes into an account that grows based on the performance of a stock market index, like the S&P 500. Now here's the exciting part. Your cash value is protected from market losses. Let's say you've built up $10,000 in your IUL account. If the market drops, your $10,000 stays exactly where it is. The market goes up, your account grows. The market goes down, you stay put. That's the beauty of the indexed feature. You get growth potential without losing your hard-earned gains during downturns. Now, the earlier you start, the more time your account has to grow, just like with any other investment. By the time retirement rolls around, it's not unusual for policyholders to have hundreds of thousands of dollars in cash value. And here's the best part. That money can be used to create what's called a tax-free retirement. So, IUL policies are highly flexible. You can fund them with almost any amount, though naturally the more you contribute, the more your account can grow over time. And unlike a traditional 401k or other tax-deferred accounts, an IUL lets you access your money later in life tax-free. With traditional retirement plans, once you hit a certain age, you have to take required minimum distributions, RMDs, and pay taxes on them. With an IUL, those withdrawals can be structured to be completely tax-free, making it a powerful alternative to traditional retirement planning. And so, indexed universal life insurance combines the protection of life insurance with the growth potential of market-linked returns, and it can set you up for a future where you're financially secure and tax advantaged. If you're under 55 or if you have children or grandchildren that you'd like to set up for lifelong financial stability, this could be a game changer. So today we've covered quite a bit on the different types of life insurance. Just like with Medicare, everyone's situation is different and unique, so planning and preparation are crucial. If you have any questions on any of these types of policies, either for yourself or your family, please reach out to me. And if you already have some life insurance, especially if you haven't reviewed it in a while, let's take a look at it and I'll give you an honest assessment. In many cases, we've been able to reduce the monthly premium or increase the benefit without increasing your costs. Thank you for joining me today. I'm Stephen Rookman with SRB Insurance Services, and stay tuned for my next video in the Four Corners of Retirement series coming soon, where we'll talk about the absolutely crucial part of retirement, planning for long-term care. See you on the next one.